From New York City for our viewers worldwide, I'm Matt Miller, in for Jonathan Farrow. Futures marginally higher as we're a half hour away from the open. The countdown starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, U.S. economic data surprising to the upside again, sending Treasury yields and the greenback higher. As Chair Powell leaves the door open to consecutive rate hikes, we begin with the big issue, global central bankers sticking to the script.
We look at the data.
We are data dependent.
Evidence-driven.
Inflation has proven to be more persistent than we expected.
More persistent.
Persistent.
Inflation expectations are rising.
Our job is to bring inflation down to 2%.
Return inflation to target.
Our baseline does not include a recession.
It is not the most likely case.
It is a worse outcome if we don't get inflation back to target.
Policy hasn't been restrictive enough.
We want to be in sufficiently restrictive territory.
There's more restriction coming.
Rates may go up by large margins.
We still have ground to cover.
We will do what is necessary.
We will very likely hike again in July.
I wouldn't take, moving at consecutive meetings off the table.
Joining us to discuss rates higher for longer in the Western world, Allspring's Margie Patel and TPW's Jay Pulaski. Welcome to the program. Thanks very much for joining us. Margie, let me start with you. Jay Powell has sort of hammered in the point that he wants to continue raising rates, even though the market seems not to believe him and hasn't for the last year and a half. What's your take?
Well, it's amazing that he's surprised that the economy hasn't responded the way he thinks it should to short rate increases. And I think that tells you the economy seems to be a lot more robust. And although there are signs here or there of the economy slowing down and employment and so forth, it really isn't. And so their strategy, you might say, hasn't worked. So they're a little flummoxed. They keep talking about raising rates, and maybe that'll kick in and hurt the economy. But I think they're underestimating the strength of the economy here and globally, actually.
Jay, what do you think? And do you believe that the Fed really is going to go through with at least 2 additional rate hikes?
Well, Matt, first off, great to see you. It's been a while. No, we don't. We think the Fed is effectively done. If they are data dependent, the June inflation number is likely to come in under 4% year over year. The decline in inflation has been as rapid as the rise was in terms of length of time. The idea that folks should be disappointed that inflation hasn't declined faster is kind of doesn't make a whole lot of sense to us here at TPW Advisory. So we're really focused on transitions. We think there are 5 transitions that are really important. They are from rate hikes to rate cuts, from monetary to fiscal policy, from recession to recovery, from bear market to rotation, and from the U.S. to the rest of the world. We think there are a lot of opportunities in risk assets, Matt.
I just want to point out, also great to see you as well, Jay. It wasn't just Sintra yesterday, right? We heard Powell in Madrid being even more hawkish. Listen to what he said.
A strong majority of committee participants expect that it will be appropriate to raise interest rates 2 or more times by the end of this year. Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go.
All right, so Jay doesn't buy it. Margie, do you think the Fed will carry through on these 2 rate hikes? I mean, you're not surprised that the economy continues to show strength.
Yes, because they really don't have any other game plan but besides keep on raising rates and see if something happens according to their guidebook. But I think corporations and individuals over the last decade of zero interest rates have restructured their balance sheets so they're not as sensitive to short rate increases as they may have been in previous cycles. Plus, in this whole cycle, there was nothing wrong with the economy, no real excesses. So the economy is pretty robust. And when you look at the equity market, you could see that industrials, transport, consumer discretionary are really, it's some of the sectors that are leading. That says to me the market doesn't think the economy is about ready to roll over into a recession anytime soon.
What do you think about the future of this market, Margie? I mean, especially as we start to see liquidity taken out. Not only you have quantitative tightening, the Treasury is going to have to continue issuing more bonds as we run bigger government deficits for longer, and we have a lack of buyers, right? As Bill Dudley was pointing out in his column this morning, the Chinese and the Russians aren't there.
Yes, that's right. I think we could have another perverse sort of market move where Treasury rates are surprisingly higher, maybe even move up. At the same time, the economy's okay, the stock market moves ahead, and corporate bonds, investment grade and high yield, really don't follow the Treasuries up, because when you look at where the supply-demand imbalance is, it's not on the corporate side, it's really this enormous flood of treasuries that we're going to get to finance the deficit. So we think the surprise might be how treasuries continue to be higher than we think, while the rest of the market chugs along and looks pretty good.
Jay, what do you think about that? Bill Dudley writing on Bloomberg this morning saying that, he thinks the Fed's going to keep rates higher for longer. R-star is going to be, their view of R-star is going to be higher. Average inflation is going to remain above 2%, and the bond risk premium is going to move higher. Do you see also treasuries rising? I think he sees the 10-year at 4.5%.
Yeah, we're in the camp that says rates are going to be higher for longer. We think the shift in policy is really from monetary policy to fiscal policy, kind of, if you want to think about it in shorthand, from the Fed to Bidenomics. And so our analog that we're working off is really the second half of the 1990s, which was the last time the U.S. had kind of a capex boom, a productivity surge, and therefore high nominal growth with limited inflation and a significant period of very solid performance for risk assets. The difference this time, we believe, is that it's going to be global, because what's driving that capex boom is the focus on climate mitigation, on decarbonization, on regionalization of supply chains. You think about semi-fabs, EV plants, battery plants. And one of the reasons why the market and economists are so flummoxed is because we haven't seen kind of the new industrial policy of Bidenomics and similar in Europe in 50 years in the United States. So no one who is active in the markets today, virtually no one, is familiar with how this playbook works. And that's why we think we see, as we note, Bloomberg Economic Surprise Index off the charts, right? At a 2-year high, the biggest one-day move in a long time, yesterday or the day before. And so that supports the rotation that is one of our main transition themes. The cyclical sectors picking up opportunities, home, housing, transports, all breaking out. And here's a real surprise, Matt, and I know you'll enjoy this. Latin American equities are outperforming NASDAQ in the second quarter. So everybody talks about a narrow market, a tech-led market, and the reality is that Brazil and Mexico are outperforming the Qs.
Amazing, because nobody outperforms the Qs in this market. And I love that you bring in some of those mega forces, Jay, that we're going to talk about a little bit later with BlackRock. Right now, I want to talk about the economic surprises, because they continue to come out to the upside. Bloomberg's Michael McKee joins us now to take us through that. Mike?
Well, Matt, it looks like that recession scenario that was coming up in 3 months has now been pushed out another 3 months, or we're getting to that point. Jay Powell worried about tightness in the labor market. Look what happened to jobless claims. They fall by enormous amount in the last week to 239,000 from 265,000. That wasn't what we were expecting. We also got a revision, third revision to GDP, which is normally a snooze, hardly ever moves, but it really rose. GDP up to 2% for the first quarter from 1.3%. And the big change was in consumer spending. Comes out at 4.2%, up from 3.8%. And most of that was in services spending. And you take a look at what we're going to get tomorrow. We get the PCE report, which will show us what happened in May with consumer spending and in May with inflation. And if we see the same kind of consumer activity carry carrying through to May. That's going to have implications for the Fed and what they do going forward. Inflation and unemployment in both of those have remained basically unmoved for the last couple of months, which basically means that Jay Powell's talk of two more moves is still in place. And do we get any more than that? We'll see what happens when we get the numbers tomorrow.
All right, Mike McKee there talking about the economic surprises. I recommend anyone with a Bloomberg terminal type ECSU Go to check out the chart because it's really breathtaking and not really a surprise to you, Margie, in terms of the growing economy. And, you know, Jay mentioned the Qs. Latin America apparently in the second quarter outperformed them, but these big mega cap tech stocks have really been on fire. And I know that you think they have more room to run, right?
Yes, I do. Of course, it's always a volatile sector, but the long-term growth rate that is really much higher than the economy. And so I think we'll continue to see that be an above-average sector, as well as those other economically sensitive sectors, because the economy just is not cooperating with the what the Fed would like to see, which is sort of a rollover into recession.
Jay, you were talking about the areas that you like in this market. Highlight them for us. You know, the cyclical versus defensive debate. What do you think about that?
Yeah, Matt, we've been really running a barbell strategy for most of this year. So within U.S. equities, remember, we run two model portfolios at TPW Advisory, global multi-asset, and a thematic model portfolio. So within our global multi-asset, we're overweight equities, we're fully invested, we're underweight fixed income. Within the equity portfolio for the U.S., we have a barbell, as we mentioned, tech on one side, cyclicals on the other, so transports, home building, energy, financials. Then within global equities, we have a barbell of the U.S. and non-U.S. with a focus on Japan. We're very bullish and continue to be very bullish on Japan and EM. We think emerging markets are going to lead the rate cutting cycle. The PBOC of China is already cutting rates. We expect Brazil's central bank and others in LATAM to follow in the third quarter. And then we have a digital physical barbell, the digital being the AI innovation cycle and the physical being the commodities. We think the manufacturing sector in the U.S. and globally is going to catch up to the service sector, which, as you noted and Mike noted, services are leading here. We think manufacturing catches up on a restocking, and we expect the same in the commodity space. Commodities have not confirmed the global economic recovery that we see unfolding, but we think that's because there's been a massive destocking in commodities, which is going to be undone as we move through the second half of the year.
I mean, one of the biggest supports to that has been Europe dealing well with the gas supply. Let's get to J.P. Morgan's Jordan Jackson weighing in on the regions he likes more than the U.S. as well.
The outlook, I would say, for the euro area, given their, I would say, heroic efforts in rebuilding their natural gas reserves, probably suggests that they can very well avoid a recession and continue to grow through the end of the year and into 2024. You probably got a little bit more upside going global than I think staying in the dollar. And that's one of the reasons why we're overweight emerging market local debts, one of our highest conviction ideas over the near term.
They're overweight emerging markets as well. Popular call right now that Jay was talking about. Margie, what do you think about regions outside the U.S.?
Well, I think U.S. is best. I think we have it all. We have the intellectual capital, a great labor force, good regulation, natural resources, and a lot of the creativity, and as well as the biggest market. Everybody wants to export into our market. So we think the U.S. is going to be a leader going forward, and we're very lukewarm on China contributing to growth. We think China's in a decelerating phase. That's why we're seeing pretty much weakness in commodities across the board, and we think that relative weakness is going to be a little bit of a weight on the rest of emerging market that depend on China, frankly.
All right, that's, well, this is the debate that we love to have. Jay Pulaski and Margie Patel are sticking with us. I want to talk, though, about stocks ahead of the opening bell. For that, we go to Abigail Doolittle. Abby?
Well, Matt, we do have the futures slipping ever so slightly lower at this moment, but we do have quite a few stocks to the upside to take a look at. Starting out with the shares of Micron. They are popping after a strong quarter. But I think what investors really like is the outlook. They're looking at sales as much as $4.1 billion in the fiscal fourth quarter. They're also talking about margins moving in the right direction, so a demand recovery for memory. NVIDIA up about 0.8% despite challenges around tightening export controls in October to China. Some analysts, in fact, raising their price targets despite this. And then Occidental Petroleum up 1.4%. Warren Buffett's Berkshire Hathaway is boosting their stake even higher right now at 25%, Matt. Again, that stock is higher.
All right, excellent roundup. Abigail, thanks very much. Coming up, President Biden continues to promote his economic policy, now called Bidenomics.
It's working. Bidenomics is about building an economy from the middle out and the bottom up, not the top down.
The latest from Capitol Hill, that conversation coming up next. This is Bloomberg.
Bringing down inflation remains one of my top priorities. Today, inflation is less than half of what it was a year ago. And that inflation caused by Russia and by the war in Ukraine and by what's going on. But we knew we had to do more. There's more than one way to bring down costs.
President Biden there promoting his economic agenda as geopolitical tensions continue to simmer. Meanwhile, Secretary Janet Yellen renewing her call to ease U.S.-China relations.
We really welcome and want to have a healthy economic relationship, and we think it's generally beneficial. We have disagreements. My hope in traveling to China is to reestablish contact. There are a new group of leaders. We need to get to know one another.
Bloomberg's Anne-Marie Hordern joins us now, and interesting that, Yellen's comments come on the heels of a report that the U.S. may want to further limit chip exports to China. How key is this relationship to the administration?
Well, it's obviously key, and you have the Treasury Secretary talking about the fact that this is her new counterpart, is also a new individual that she wants to get to know. She also said if she goes to China, Matt, I reported alongside Jenny Leonard that she will be going to Beijing in early July, and July obviously starts next week. And it's going to be a tight rope for her to really walk, because while they are trying to have more dialogue, these are the two biggest economies in the world, the rest of the world want to see Beijing and Washington have appropriate dialogue. The fact of the matter is, relations have been icy, to say the least. And it's going to be difficult because at the same time she's going, it's not even just the export controls on potentially semiconductors that are really important for the AI technology space, but also we've been reporting that the administration is ramping up the work on that outbound investment executive order, which would mean that there's going to be U.S. investments potentially cut off or regulated about going into China. So it's going to be difficult for her to walk. But the fact that she is going in itself is somewhat of a win for the administration. They've wanted to have more of this dialogue between principal and principal between Beijing and Washington.
But as you say, it's a very tight rope, right? Biden needs to appear hawkish on China going into an election, and it kind of plays into his Bidenomics plan, this deglobalization, this reshoring of manufacturing, doesn't it?
It certainly does, and just expanding the productive capacity of the U.S. economy, as the Treasury Secretary would herself talk about it. Also, the fact that this president always talks about and campaigns on the fact that he wants to be the most pro-union president in history. Well, to do that, it's probably one of the reasons why they decided to keep the Trump-era tariffs on China in place. This is something that really can help him when he is looking to talk about the economy with everyday Americans. The issue is, Matt, as he is out there in Chicago yesterday talking about Bidenomics, which, by the way, pretty sure this term stemmed at first from a Wall Street Journal editorial that was criticizing the administration. They are trying to own it and define it on their own terms. But this poll, Matt, almost 6 in 10 Americans say they disapprove of the way Biden has handled inflation and prices, according to an Economist YouGov poll. That does not bode well for an incumbent president looking to go into an election year when others are also potentially predicting a recession.
All right, Anne-Marie Hordern from Washington, D.C., thanks very much for that. And congratulations, by the way, on the Yankee no-hitter last night. Jay Pulaski and Margie Patel still with us to talk about the potential of that recession. Margie, what's your view? Do we actually go into a recession, or, can we avoid it before the election?
Well, I had looked at all the indicators, and I felt it looked like we'd have a mild to severe recession, say 3 months to 12 months from now. But as time has passed, it just doesn't appear so. It appears the economy is very resilient, and we're having a little growth bump, not only here, but really around the world. You can see that in Europe and some of the emerging markets you highlighted. So I'm not so sure that we would have a recession anytime in the next year. So maybe we have to push it out till there's some sort of unforeseen development. But the economy looks in good shape, consumers look in good shape, and we still have the benefit of some of that stimulus money from COVID sloshing around that's going to be spent to help offset any pinch on consumer income. So there's really more of a very positive outlook for the economy. The surprise is on the upside rather than the downside.
Yeah, bank deposits remain meaningfully higher than they were pre-COVID. Jay, what's your view on the potential of a recession in the next, say, 12 months?
We've never been fans of the recession idea, Matt. We've been talking about a middle path between high inflation and deep recession for the last year. That's one of the reasons why we've been fully invested, overweight equities, underweight bonds. And as we look at the world economy, we see a desynchronized global economy where Asia is leading the global economy into an early cycle recovery. Japan is growing well above potential. China, for all the China bashing, is going to grow at 5%. Broad Asia, Southeast Asia, India growing 5-6%. And then the U.S. and Europe kind of coming up behind them as the central banks go on hold, as inflation falls, consumer incomes rise, and manufacturing, as I said before, picks up to services. We're quite constructive on Bidenomics, and we think it's a global issue. That's the regional deepening is something that we're big fans of here at TPW Advisory.
All right, Jay, thanks so much for joining us. Jay Pulaski there and Margie Patel. Always a pleasure speaking with both of you. Coming up, the morning calls, and then later BlackRock's Jean Bovin joins us around the opening bell to talk about the mega forces. That conversation still ahead. This is Bloomberg. This is the countdown to the open. I'm Matt Miller in for Jonathan Farrow. Just moments away from the start of trading, and we're looking at Fidelis Insurance Group at the New York Stock Exchange. Beloved Arise ringing the bell at the NASDAQ. Futures pointing lower on the S&P and the NASDAQ, but higher for the small caps. All right, one sector to watch at the open is the financials. This after the big U.S. banks trading higher in the pre-market as their stress test results lift the sector. The Fed writing, quote, the large banks are well positioned to weather a severe recession and continue to lend to households and businesses even during a severe recession. So a little bit of an echo there, but they're not professional writers. Bloomberg's Abigail Doolittle joins us now for more. So, Abigail, the financials have started to support this market again.
Well, you know, it's interesting, Matt. I'm first going to talk about whether or not they're professional writers. I'm guessing that the Fed has teams of people who are very carefully crafting the wording. So the fact that there was that double mention of a recession is sort of interesting. Not surprisingly, these big banks did pass the stress test. The fact that you had a number of these banks rescuing some of those regional banks suggests that they were already in a strong position ahead of that. As for this year's stress test, the actual scenario that was involved was a U.S. unemployment rate surging to 10% 10%. The big one, commercial real estate, if those prices plunged by 40% and then the dollar jumped. So all these banks have enough capital for that type of a scenario. The interesting thing, of course, is whether or not they'll be able to offer dividends and payouts, and they will. But many of these banks are saying that they're waiting for more news, more information on what supervision will look like in the future before really making those payout plans. But net, this is a positive for these banks, and most of them, with the exception of Citigroup, are trading higher here on the open, Matt.
Even Citigroup eking out the occasional gain there, swinging back and forth between gains and losses. Abigail Doolittle, thanks very much for that. We're also keeping an eye on the regional banks. JP Morgan has downgraded Citizens Financial to neutral, writing, quote, Citizens has a lower cushion relative to their bigger peers. I'm sure they meant its bigger peers. In addition, Citizen is being pressured by high losses on its CRE loans. Joining us now to talk more about this is Sonali Basak. So, Sonali, I guess we're still concerned about KRE.
We certainly are concerned about KRE. We're concerned about the ones exposed to commercial real estate. We know the scenario had a 40% drop in commercial real estate prices. It was a significant amount of the expected loan losses in the provisioning alongside credit card losses as well. So Citizens Financial, Capital One, Truist, and Citigroup are the ones expected by Jefferies to see a higher minimum CET1 ratio, which is why you're seeing a little more pressure on Citigroup relative to the other big global banks. And then you have many other analysts here thinking that the regional banks, particularly Mike Mayo, believing that the regional banks are not going to be engaging in buybacks in the near future, given the pressure on capital that you're seeing, particularly coming out of the stress test, and with the potential of more regulatory concerns ahead, Matt. So when it comes to the pressure on the regional banks, add another problem to the table. The worries about how much capital they're going to keep on board to kind of weather any potential future storms that the regulators require them to hold out for.
All right, Sonali, thanks very much. Sonali Basak there talking to us about the regional banks. After the big bank stress test, we're focused very much on financials today. Let's turn our attention to earnings season, though, for now, because Micron is the headline there, topping earnings estimates and providing an upbeat forecast. The CEO at the chip maker writing in a statement, quote, we believe that the memory industry has passed its trough in revenue, and we expect margins to improve as industry supply-demand balance is gradually restored. Joining us now on the DRAM situation is Bloomberg's Katie Greifeld. Katie?
Well, Matt, it's interesting. Just as the bell was ringing, you've seen Micron flip into the red. Shares currently off about 2.5%. They had been 2.5% higher in the pre-market, and that's all because of that strong forecast that the memory chip maker gave. Sales will be as much as $4.1 billion in the fiscal fourth quarter. The average analyst estimate, for context here, had been $3.87 billion. So a lift there. And of course, you mentioned that the CEO was saying that the trough in revenue has passed. That's the expectation of the sell side, it seems. Of course, Piper Sandler upgrading the stock. But there was a note of caution when it comes to China. Remember that the Chinese government had decided that Micron's products pose a security risk. We also heard from the CEO saying that that poses a, quote, significant headwind that is impacting our outlook and slowing our recovery. So maybe you're seeing some of that in the share price today. Micron now off 3%.
All right, Katie Greifeld, thanks very much for that. Let's stick with tech and talk to BlackRock right now, because they are getting in on the AI boom, writing, quote, we implement an overweight to AI as a megaforce. New AI tools could analyze and unlock the value of the data gold mine some companies may be sitting on. And in fact, some people are using AI to unlock actual gold mines. Joining us to discuss is BlackRock's Jean Boivin. Jean, thanks so much for your time. You know, AI is just one of the mega forces that you and your colleagues at BlackRock have laid out, but it's the most exciting for us because we've seen this incredible rally. Does it still have legs, or is, you know, the excitement priced in?
Great to be here, Matt. Thanks. So yeah, I think as you say, there are more than one mega force. We see the world now as being less about macro. The macro environment is not really your friend. So you really need to think about underneath that, what are the key structural forces that will play out over many years? And we think AI is one of them. We have four more: demographics, we have the future of finance, we have the rewiring of geopolitics, among others. So this is the broad picture. And when it comes to AI, this is not a story of just the last few weeks, few months. I think what we've learned this year, which is pretty clear, is that even in an environment where the macro is very challenging, and we think recessions risk are real, inflation is not under control, you cannot go with a macro thesis, but there still is powerful opportunities like AI. It has run its way quite a bit this year, and questions about valuations and so on are real. But at the same time, we think two things. One is that the earnings outlook are real. I mean, this is not like just speculations about possibility of earnings. There's a real demand for what this technology is doing. This is not like the metaverse that we've seen, stories we've seen a year ago or so. There's something real there happening. And then the second thing is that in this environment, you need to be nimble, much more than before. You cannot just sit and wait for the portfolio to generate returns. And it's going to be a question that needs to be tracked, so those valuations. So right now, we think this has more momentum, but this is something that will be reevaluating on an ongoing basis over the course of the months to come.
Yeah, I look at NVIDIA, I mean, as most people do, to gauge how this is going. And frankly, the forward PE is now lower than it was after the initial surge of the stock. We're looking at 54 right now. I think it was 60 a few weeks ago because the E has been raised so much. Am I right to focus on NVIDIA, or are you looking at, a broader basket of stocks that could benefit from this?
We think it's kind of a thematic. That's why we use the word megaforce. It is not only about like the names that we hear, the 7, 8 stocks that have been carrying the entire market for this year so far, very concentrated. It's not a broad market story, but it is a megaforce. And I think this is not only about chip makers or others. It's also about like the AI in healthcare. This is about like how companies will be able to use Copilot to do a lot of things now that they're being done less efficiently. So this is the broader theme that I think we need to think about: baskets, ways to cut this theme across the stock universe. And while the U.S. markets, we are overall underweight on U.S. equities, it might be providing as well the best opportunities once you play it with this mega force in mind.
Jean, away from AI, the other mega forces that you write about are deglobalization, the green transition, the aging demographics, and a fast evolving financial system. Which others excite you the most?
Well, I think they're all important, and that's why we typically you go with 3 things. It's always better to have 3 things on the table. We went with 5 because we think they're all important. But I would say one I think is interesting because underappreciated is the reshaping of the financial system. That has been a long-term trend since the global financial crisis of 2008. So it's been happening, but the way we look at the banking turmoil of the last few months is an acceleration of this mega force, one where we see as a result a role of banks that will be evolving, but will also give space and create space for other sources of funding for the global economy. And in particular, we see private credit as being a space that's going to benefit from this reshaping of the financial system.
Yeah, so shadow banking is what we kind of used to call that. And of course, private credit has been the hot topic for months or the last year now. How does the rate picture play into that? Does it matter if rates continue to rise higher for longer? Does it matter if the Fed has to end up turning around and other central banks and cut rates over the next couple of years?
So there's a macro story here, more broadly, that I think is pretty important in terms of the rates, which is why I started by saying macro is not really your friend in this environment, because we think we're going to be in an environment where central banks will have to hold tight to have a systematic tightening bias, which is the complete opposite of the last 30 years before 2020. We're just waking up to that. Markets have not fully adjusted to this. They're still expecting 100 basis points and more of cuts in 2024. We don't think central banks will be coming to the rescue. So this is going to be a higher for longer environment, rate environment. It needs to be played out across asset class. Of course, credit in general is a place where you want to think about the rate implications. We are broadly neutral on credits on a cyclical basis as a result of that. When we talk about shorter-term duration and income, that's pretty attractive. But more longer-term duration, that is something that will be impacted by the rate landscape. But when it gets the private piece of it, then it's more of a mega force story. It's not only about the cyclical rate piece. There's an additional tailwind which is this reshaping of the financial system that is happening.
That's really interesting. So the changing financial system there, a lot to do with private credit. The aging demographic is something that investors have been playing for a while now. Is it not already played out? I mean, hasn't everyone seen that among these megaforces more than anything else?
Yeah, I think demographics is the easiest thing to predict, right? If you're in the business of trying to understand what's going to happen 1 or 2 years out, if you're dealing with demographics, that's a pretty easy gig because we know pretty much where demographics will be 20 years in advance. So in that sense, there's no new news if that's the way you look at it. But on the other hand, I think this is something that what we've learned also over time by looking at these phenomena. They really start to move asset prices only when the implications on demand for like things that are related to demographics, like baby strollers versus wheelchair. It's really when the demand is shifting and it's materializing that you see really stock prices, the company prices, stocks adjusting. So even though it's highly forecastable, this is something that will continue to play out. I think there's still it's not fully in the price. And then the macro implications we think are underappreciated. The inflationary implications of this aging population that is tightening the labor market for structural reason is something that is not in line with people expecting inflation to fall very quickly and easily. So again, I think these are aspects of demographics that are crucial, fundamental, and not fully appreciated.
And fascinating, I would say. Jean, what do you think about the macro implications of the transition to a low-carbon economy, of the green transition?
So we've been working hard over the last few months to get smarter on how the climate transition is likely to unfold over the many years and decade to come. We will be in a position actually soon to unpack that a lot more. But that is a complex phenomenon that's going to play, we think, along like fast lanes. So there's going to be sectors that are going to be accelerating and moving much more quickly, and there are other sectors that are going to be stickier. So all the electrification of the world, the retooling around that is something that is going to be happening over the next decade. Has been playing out, will continue to play out. There's things that will be unlocked later down the road. There'll be winners and losers. And so that's not a simple story about like let's go long one asset class versus the other, but it's something that's going to require us to play it more granularly in portfolios, which is another big theme of our outlook we just released, which is the need to pivot to new opportunities that are more granular.
Yeah, I saw that and thought immediately of Tom Keene. He appreciates that kind of language. In terms of the rewiring of globalization driven by geopolitics, is this really deglobalization, or can it mean more than that? What's the investment play there?
Yeah, we avoid that. I don't think you'll find the word deglobalization in anything we wrote. We tend to use things like rewiring of globalization, because what is really happening is not like things moving in reverse, but it's really like we're reshaping the way we're producing globally. I think there's really a story, not new, but it's continuing to play out around the fact that global companies are focusing a lot more on resilience of production as opposed to efficiency of production, which was a story for 40 years before. So that change is important. It creates another reason why we think inflation is going to be forces and pressure will be persistent, because cost of production will be structurally higher as you rewire globalization. But it also means that as these supply chains are readjusted, it will create opportunities. We want to look at the emerging market differently now through that lens. And geopolitics is maybe the starting point that is more important than looking at macro fundamentals when it comes to EM investing as a result of this theme.
John, awesome to get some time with you. Thank you so much for joining us. Jean Bovin there, coming to us from BlackRock on the mega forces that I think everyone paid attention to this note yesterday, and we're going to keep it in our back pockets. Coming up, Wall Street's banks passing the Fed's stress test.
The positive of these stress tests are that it has created a more sophisticated and aware management team within these institutions that aren't just focused on today or yesterday, but more importantly, going through scenarios tomorrow.
That conversation still ahead. This is Bloomberg.
We have not bought into the all clear scenario. Our sense is that these are the kinds of things that are, slow melting icebergs. Our best guess is this is far from over.
Wall Street's biggest banks passing the Fed's annual stress test, proving that they, quote, have sufficient capital to absorb more than $540 billion in losses and continue lending to households and businesses under stressful conditions. Fed Vice Chair for Supervision Michael Barr adding that the results, quote, confirm that the banking system remains strong and resilient. Bloomberg's Sonali Basak joins us now. And Sonali, what was your take on the stress test? The investors that you talked to on the phone all day, are they, more sanguine now? Are they calmer? Is everything cool?
The general sense here is that, as Mike Mayo says, Goliath is winning. The biggest banks are set to fare the best out of these stress tests in the sense that they really did hold up strongest against the storm. When it comes to the regional banks, there are some expectations that their minimal CET1 ratios might rise, particularly for the likes of Citizens and a few others, which is you're seeing the reaction in the market. Of the global SIFIs, you see Citigroup faring the least good of the group, if you will. I also like to look under the surface a little bit and see how the banks did, even if they did pass the stress test. For example, that exploratory market shock, which did not count towards the capital requirements this time around, the reason it matters is because in the future it might. And when you look at how the banks fared for the global market shock component of that stress test, you saw the steepest losses, projected losses in the scenario at Goldman Sachs, which also saw some of the steepest losses when it came to the credit card portfolio as well as commercial real estate. So it's interesting to look under the hood here, even if they passed, Matt, because the question is, what is the direction of travel moving forward? In the nearest term, you have Jefferies expecting that JP Morgan will show the biggest improvement here when it comes to the reduction in the CET1 requirements. And even what we saw for Goldman Sachs and Morgan Stanley, they expect for them as well a reduction. So again, as Mike Mayo said, Goliath is winning. Some stress on the regional still moving forward, no expected buybacks, but we'll see how things fare out as the reins start to tighten on the financial system even more.
All right, Sonali, thanks very much. Sonali Basak, our Wall Street reporter, talking to us about the stress tests for the big banks. Meanwhile, regional banks are changing tactics in order to shore up their books, borrowing billions of dollars from the Fed, tapping into the Federal Home Loan Bank system, and leaning on brokered deposits. Bloomberg's Jenny Serrane joins us now to talk about her hot money story. And excellent reporting, Jenny. I was really surprised by what seemed like a little bit of a sketchier strategy in order to get dollars onto their books. Is this a problem for long-term sustainability?
Yeah, I think what we're thinking of this as is really the next phase of this banking turmoil that we've been in for the last few months. The first phase was really the swift collapse of several large regional lenders who were stung by, a run on deposits after the Fed had raised rates so rapidly. This next phase is going to take a lot longer. It's going to be a lot more of this kind of grind through. You've got this huge increase in borrowing costs at a lot of these banks, and they're really just now kind of coming to terms with what that will mean for their profits. And so, yeah, you've really seen this huge uptick in brokered deposits, hot money, as regulators like to call it. You've seen a huge uptick in Fed borrowing and FHLB borrowing, and that's really coming to bear in interest expenses, only right now. And so I think this next phase of this crisis, of this turmoil, is really going to take a lot longer, and you're going to see it hurt a lot more of these mid-sized regional banks.
I didn't even know brokered deposits were a thing before I read this story. Who are these brokers, and do the banks always use that kind of source?
So it's there for them when they need it, and it is something that they've had as an option for years. It's not totally new. These brokers are kind of these little-known intermediaries, and they basically connect these banks with wealthy individuals, wealthy companies who want a better rate on their cash. And so I think, it's always there for them when they need it. It's not a totally new phenomenon. Regulators have always hated these types of deposits, but it is a good option if you're facing a real, crunch on your balance sheet.
All right, it's kind of like a payday lender. I think you don't want to use it very often, and obviously the rates are higher. Jenny, thanks very much. Jenny Serrane wrote the story. Definitely recommend you check this out on the Bloomberg, especially as the financials now seem to be supporting this market in a stronger and stronger way. Coming up, the markets moving events that you need to be watching. That's next in our trading diary. This is Bloomberg. now for the trading diary, what you need to be watching through the next week. Nike earnings out after the closing bell. PCE inflation data on Friday. U.S. markets are closed, of course, on Tuesday for the 4th of July. The Fed minutes on Wednesday and the U.S. payrolls report on Friday. This was the countdown to the open. This is Bloomberg.